So we continue to march slowly and grindingly higher to some pretty decent extremes, especially in the small cap index now. I've shown you other extremes before, like within the S&P and the NASDAQ previously a month or so ago. But now we're starting to see it again, like we saw it in June in the Russell. Much stronger extremes on a historical basis than we even saw in June. So I'm going to break that down, what that means. Like, does it immediately bearish? Is it actually immediately more bullish in terms of this grind continuing? So I'm going to talk about that. I'm going to talk about kind of how the sectors are performing within these moves the past few days, especially, and why that can actually be a positive sign for the markets. And then we'll take a look at today's trade idea on a stock that's showing its own little bullish, pretty nice little bullish bounce pattern. So let's go ahead and get started. Today is Wednesday, December the 16th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, another up day here coming up off of a near-term low point to a new high, matching so far the previous near-term high. Not quite getting through there yet, but matching it so far. Not even dipping really down to the 23% level. So a little bit, I mean, obviously we're going to get near-term highs and near-term lows on an intermediate run, and that's kind of what we're getting right now. Market sentiment's rising. It's already back above 70. Momentum line falling because of the smaller range today, but not significant. Very similar pattern on the Dow. As you can see, it's also trying to approach this high point, not really breaking through one yet. The NASDAQ did get a new high today. Its near-term line well into the reversal zone, strong bullish posture as well, market sentiment rising. And then finally the Russell, which continues to be the strongest index here. Little tiny bit of a down day today, but strong bullish posture with the market sentiment and the near-term line up there. Just the small range, very, very small range today, like minuscule. The average range for the Russell is 33 points, and we were at 19 today. So very, very minuscule range, suggesting that a little bit of a pause, slow down, not a pullback, but a little bit of a pause because of how bullish we've been. And if we're going to maintain bullishness, you're gonna get smaller and smaller ranges and moves, as you can see here. When you look at it on this perspective from the S&P 500, we had a pretty decent day yesterday to the upside. Up here at the top, this is the gain for the day. Down here are the gaps, and you can see we haven't had any gaps that are significant enough to be considered either a runaway or breakaway gap, which means that will most likely fill in these gaps. And you can see also too the gap between the volatility and historical volatility remains relatively big. And usually those two lines come together when there's a gap, one way or the other. Either the purple line falls, which means volatility breaks below 20, or the historical volatility jumps up. With the historical volatility being relatively low, it's higher than it was over here late last year in the early part of 2020. So it was a little bit higher, but it is relatively low. If you take a look at some of these other oscillators here, like the Bollinger Band for SPY, and you can see we're still trading up within the upper band above the value area. What you're not seeing, or what's discussed, is how much we're up above the value area and the point of control in the Russell 2000, which is maintaining its own bullishness there. Excuse me, which means just kind of keep an eye. I mean, it's a pretty parabolic move that the Russell 2000 has been on, and an opportunity for you can see a drop without very much support from a volume standpoint between here and back down to about this 168, 165 level where the point of control is. So going back to the market forecast, still maintaining bullishness, still maintaining a new near-term trend. The question is how strong and how long it's going to be. Obviously, you'd expect, coming off of a higher low, that we move up to a higher high. You'd expect 7 to 12 days. I don't think that we'll get that. We could, right? Because that's typical. It's a typical time frame. I just believe that we're kind of nearing the end of this intermediate rally, which is going to make it a little bit more difficult to push through significant new highs, since the catch-up trade on the Russell appears to have caught up. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us that you liked our video today and you want us to do another video again tomorrow. Quick way to give us feedback. Let us know what you're thinking. If you don't like our videos, of course, you don't have to click on anything. Also, while you're down there, comment. What did you get out of our videos today? What stood out to you? What questions or comments do you have? Post those down below. Join our website at marketscholars.com. There's a link popping out there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. There's my handle here at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog here, check out these classes and videos over here on the right. This is our Market Outlook live video. Every day I do the Market Outlook. I also do a live trade review. I go back and look at all of our trades that we've talked about in these videos here at the end of all these Market Outlooks that I do. We review them, we manage them all the way up to the time that we close them. So I look at that every day. I do the Market Outlook. These are all of our trading rooms and premium Q&A sessions that we have for our premium subscribers, as well as our trading rooms for all of our subscribers. And then finally, come down here, click on this heart. It opens up a new window. Hit that like button right there. Also click on this thumbs up. Also opens up a new tab. Click on the like button here as well. Again, the more you do that, the benefits us, because our content will be seen by all of our followers with the more likes it has. It also benefits you because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. We try to make it really easy for you to engage with us here. All right, now let's get back to the charts here and take a look at the S&P 500, and you can see the candles on the S&P are just gradually getting smaller on the Heikin-Ashi candle. If you look at the differential here, this indicator measures the size of the Heikin-Ashi candle, and you can see how, generally speaking, you will start up high. Really right off the bat, you'll start up high, and then we just kind of gradually move down. And really, this, you can see this candle, the size that we got, it's relatively big. Now, this is on an absolute basis because of the size. It's not relative to the price. It's on an absolute basis. So as price rises, the candles will just naturally get bigger. So that's kind of the nature of that. But you see how we've been gradually getting smaller, which is the green line. And the purple line is a 3-day average of that. So it tries to smooth it out a little bit. So this is what, if I were to take off the green line here, you can see the smooth average to kind of get an idea. Again, pretty darn high, but coming down from these levels with a very, very high PPO. To kind of give you an idea, on the other hand, look at the Russell 2000. So the Russell 2000s have peaked. You can see the candle sizes have peaked here, and they're starting to roll over as well, even though it's still relatively large at 88 points. On a 3, remember this is a 3, if I were to 3-day average of it, if I were to show this plot and take off the average, then you can see what the regular candles. So we've been gradually starting to get smaller after peaking on the Russell with these two really strong candles the week of November the 9th and then the 16th. And obviously the PPO is very, very high. In fact, if you look at how high right now we are, the current price of the Russell above the 200-day moving average, if I were to go all the way back to as far back as we can go on the Russell, so this goes back to the December of 96, this is the data point we have on this. This is the highest it's been, or close to the highest. Only here was just a smidgen higher. We're in the 95th percentile. There's only been a few instances where the Russell has been in the 90th percentile in terms of how far above the 200-day moving average we are. One was right there in 2000, and you can see what happened afterwards. And then one was here in March of 2000, and you can see what happened afterwards there too. So here's one instance here as the actual Hakinyashi candle got the biggest at the end, so that was kind of a blow off top kind of a move there in March of 2000. And we went down, and then going over to 2010 right here, you can see that we had started to come down by the time we got that. So we had peaked early and then have been gradually moving lower with a little bit of a divergence here in the size of the Hakinyashi candles before we came back down. And here we are again, with, again, peaking here early and gradually coming down in the size of the candles, with very, very high, being over 20% above the 200-day moving average. And you look to see, okay, well, how far above the 50-day moving average are we, or 10-week moving average? And we're also in the 93rd percentile there too. You can see some other instances of being in the 90th percentile, multiple instances here. If I were to zoom in just a little bit, the more recent ones that we've had are right here. A little bit of a drop there, and then another one right here. And we kind of went sideways and had a little bit of a drop to the 50-day moving average as well. You come over here to this instance right here. We were pretty far above the 50-day moving average, and we kind of went flat after that peak. And then you can see another one here where we were pretty far above the 50, and we came down to the 50 and eventually to the 200 in 2010. And you can see other instances where you get really decently above the 50 and we just kind of go flat for a few weeks, or down to the 50 after getting such strong moves. So here we are again, almost 10% above the 50, 22% above the 200. Very, very strong moves. You can also see it too in the directional movement index, IWM. It's not very common for the Russell 2000 to have its ADX up above 40 on a bullish move. It's very, a lot more common on bearish moves, but not very common on the bullish moves. And every time we have had those bullish moves with the ADX above 40, it's hard to kind of sustain those moves. And with the negative index also down below 10. So that's where we're at right now on the daily chart. The negative index way down there, the ADX well above 40. So showing this, basically it's a parabolic kind of bubbly move on the Russell 2000, not surprisingly. If you take a look at the weekly chart for this, to kind of give you some perspective on that. Again, this is about as high as the positive index has been on a weekly chart, going all the way back to 2017. Here, or excuse me, the end of 2016, you can see the kind of movement we had afterwards. And then again over here in 2003, coming off of that major bear market low. We actually went a little bit higher and diverged with that lower high point before having a period of weakness. So needless to say, now we don't have a strong negative index yet, and the ADX itself is actually just barely moving up above 20. So over here, that's kind of what the case was here too. We 2016, we got that strong positive directional index. The ADX was just barely crossing above 20, and then as the ADX rose, the positive index was dropping pretty sharply. So we're going to keep our eyes on this. It looks a lot more parabolic here on this chart than it appears because of the log scale, right? So it still looks relatively parabolic with the directional index moving as it is. And if you look at the Bollinger Bands, I mentioned before, not as, you can see there's SPYs, but you can see a much bigger area of margin of safety that's not so good on the IWM. You can see how easy it is to come up because there's not very much volume here. It's all-time highs, and just as easy as it was to come up on very low volume, there's not very much volume holding it up compared to something like SPY, where there's a lot more volume underneath us here above the value area, and compared to QQQ, where again we're well above the value area, but there's a good chunk of volume right there that can keep us and hold us up. Again, going back to IWM, not so much. So kind of gives you an idea of the potential risk. The reward, we all know that as I mentioned, the trend is strongly bullish, and we've been in a multi-month intermediate run on the Russell 2000 ever since the beginning of October. And that's the reward that will continue. Granted, it's already 2 months in, but the risk is all the way back down to at least this 165 level, these old pre-COVID highs, because we've gone up so much so fast and we're so extreme in these indicators. That's how fast it can come back down. And you can also see that too here in the the one I wanted to show you was the RSI and the CCI. You can see how long we've been above 70 on the daily chart, but on the weekly chart, again, it's not very common for us to get an RSI up above 70 on the weekly chart. You can see we did here in early 2018. We can see in 2013 multiple touches. This is one actually, though, unlike these others, where the CCI also got above positive 200. So again, just another signs of extremity when you're looking at the strength of the Russell 2000 right now, the parabolic type move that we have going on. Now let's take a look at the intraday move for the S&P. And you can kind of see we're flirting up with the highs. We got a new high tag today, just barely. I think the other one was at 371.05 there, and now we're at 371.16 here. So we got a new 4-week high tag. The low tag is continuing to move up. It'll be a couple more days, and it'll be a few more days after that. We won't move up very much, and then a week from now we'll make a pretty big shift up to this 360 area. Now we're only looking at about $11 move, depending upon where the next high will be. So we're really starting to tighten up the range on SPY, even if we haven't necessarily yet here. It's a $20 range on IWM on a $195 index, so that we're looking at like a 10% range, so pretty wide. But again, that within a week that will move up too at about 180. So we're looking at 15. So we'll still be over 5%, still pretty wide range, but it'll also start tightening up. And again, the wider the range, the easier is it to move within the range, and still be kind of a noisy period, so to speak. I mentioned the moves, generally speaking, between 0 and 23% just represent noise, and I drew that Fibonacci line retracement level on the S&P. I have it here on the Russell 2000, so you can see on the Russell, for us to come down to 1840 would be just again a noisy period for the Russell 2000. To kind of give you an idea of what that looks like here on the intraday chart. That would be all the way down to here, to the just below the midpoint of the range, all the way down to that level. So when you have such a wide 4-week range, you can have bigger moves and still be considered noise. Let's take a look at today's range and volume. Volume below average at 58 million. The range also below average, well below average, at only 2.25 points. So that's obviously having its impact here on these indexes. The volume still continuing to trend lower. The trading range is also down. Let's see, here's the trading range. The volume is still lower. The trading range is trending lower. It's still not breaking that 1% level yet. You can see, as I showed you here, as long as we continue to get really quiet moves, it's going to be a slow glacial pace. The problem is this gap here, and how does that gap resolve itself? Over here, the gap resolved itself with volatility coming down. Over here, the volatility, the historical volatility ramped up. So we got that. This was the September intermediate decline that we had. So we're getting another gap, not as pronounced here, but still pretty low historical volatility, and we're still above 20 on the VIX. So how are we going to resolve that one? The VIX is still easily above 20, though it's still in the upper ends of the bullish territory for risk appetite, as it's just barely below 90%. So we'll kind of keep an eye on that. Looks like it's going to have a hard time breaking to extreme lows here without the index itself breaking below 20. If you take a look on the daily chart, on the weekly chart is what I wanted to look at. If you take a look at it on a weekly chart, you can see, after kind of bottoming out here at the same levels in August, right before that September peak, the VIX fell to about below 80% of the 3-month VIX, the VIX 3M. Not the case this time. Same levels, but a little bit higher. We're only breaking down, we're forming a low around the 85% mark. So a higher low point developing on the volatility that may bring us up to a higher high point on this next intermediate decline. Remember, we can go all the way up to about 100, 105% and still just be an intermediate decline. If we hit that 115% mark, that's kind of, on a closing basis, that's kind of a sign that we may have more than just an intermediate pullback. It may last longer enough to be more of a market sentiment pullback. And of course, 125% or higher, and now we're looking at it lasting long enough for a death cross to form out of that. Potentially, of course, those are just targets, and nothing's set in stone or 100%. So, but those are ideas, and so even though we might get a higher high, I wouldn't expect it to be too much higher than 105% on a daily basis, but a little bit higher, as and I don't know when that's going to be. It might not be it might not be this week. Most likely won't be this week. Won't be next week, most likely. But we could be looking at it within a few weeks as we get through December expiration and the end of the year, and then heading into 2021 with potentially a new Congress, but we do know a new presidency, and then a new vaccine and all the economic ramifications that can have globally. All right, so to summarize our technical outlook, obviously the trend remains bullish. We are in a new bullish near-term run. We also have to recognize the extremes in the Russell 2000, the parabolic move we've seen that's brought that relative strength line. I'll show you here in a minute of the Qs down to the Russell. But in the short term, obviously that's bullish. Momentum can ride. You can ride strong momentum for as long as it will take. But the risk reward starts to become an issue in terms of how much reward there is at extremes versus the risk of things moderating, and how much and how fast it can moderate depending upon how extreme things are. So that's why we have to kind of have a mix of shorter term bullish trades that won't necessarily get hammered if there is any kind of moderation, and some kind of opportunity to hedge ourselves if we do get that moderation, if and when it happens. So having a good mix like that allows you to be able to participate in the bullishness, but be prepared in case it runs out without getting blown up, which is what usually happens when people are participating in strong momentum moves. They ride the strongest momentum for as long as they can, but they can't get out of it fast enough, so they lose. The strongest momentum is also the strongest losers whenever there is a pullback, and we wait to see if it will bounce back up, and we'll try to get back some of those profits before we get out, and we don't, and that's how we kind of ride it up and back down. You don't have that issue if you have a mix of shorter term bullish trades that aren't so directional at the extremes, and a hedge, and hedges on some negative delta trades, particularly in that small cap space, that can help you. So what do you think? Do you agree with that technical assessment? Do you disagree? Comment down in the comment section below, especially if you disagree. Let me know what you're seeing, what charts or indicators you're looking at that either tell you to be a lot more bullish than I am or a lot more bearish than I am. All right, let's come back to the charts here. Let's take a look at what's driving the price action here this week. You can see the 3-month charts and how things are continuing to perform. But let's just go this week so far. So we'll come down here to December. We'll look at the 14th going into today's session. And you can see the snapback in the Qs relative to IWM. So we're getting some renewed strength in the big large cap tech space, with our safety trade really underperforming down here. If we take a look here at the relative strength chart, here we go. You can see how things are performing here this week. So we're bouncing up a little bit. We're kind of coming down on the RSI of the relative strength chart to the 40. The histogram, I think I mentioned to you before, is starting to roll up a little bit here, even if the PPO is finally going negative. So it appears like this is the extent of the outperformance on the Russell 2000. We don't want it to break too hard to the downside because, as you can see here, if we break too hard, if I go back as far as we can go here, let's go back as far as we can go to I believe that's, yeah, we don't go too far back on these ETFs, but you can see when we break too hard to the downside, that's usually because we're in the bear market. And so we're not looking necessarily for this to break down hard, but breaking down where we're at right now and then bouncing back up is the expectation, because we do seem to be at some relative low points here. So that's kind of the idea. And if you take a look at the how many stocks are up above the 200-day moving average, here, let's go 200-day moving average on the S&P 500. You know, again, we're still, even with the little bit of a drop here lately, we're still at very, very high levels at the 89% mark, whereas the 200-day moving average is still way down at the 53% mark. So it's a very big, quick spike, and usually when we have quick spikes like this, when the moving average is still low, we get, you know, the little bit of a drop. This was in early 2012, one of the last times we've had such a spike. Other spikes like this coming off the 2009 low, where we stay up high coming from really low levels. I mean, obviously these were bear markets when you had the average this low. Here's another time where we had it this low in 2016. We got up to 80% while the 200-day moving average was still low, and we had a couple of snapbacks down below 55% on the index in 2016. So to kind of give you an idea of what that looks like here on this chart, if I were to go back to those two periods in 2016, so yeah, let's go back 10 years. 2016 would be this one here, and this one here would be the times where we had a little bit of a snapback. So you notice they didn't drop down, you know, sharply below the 200-day moving average. If you look at the regular candle here, we never did close below it there. We only went below it on the intraday basis briefly in June. We did close rarely below it in October before bouncing back up on the election. So that is, those two drops are these two drops, where you can see the line dropping just barely to 55, below 50%. At the time of the first one in June, the moving average was, you know, about where we're at right now. So, and we might not drop all the way to 55%, because we are higher now than we were then, 89 rather than 80. But you get the idea. It's hard to sustain extremes like this when the moving average is so low. So this is a chart of how many stocks are above the 200-day moving average in the small cap index. This would be the S&P 600. So not quite the Russell 2000, but the S&P 600. And if I were to go back, we can only go back 5 years on this chart. And I've also got the index itself listed there. But we are, I mean, this is the highest level we've had in the last 5 years. So very, very high level. We're outside of 2 standard deviations, which is extreme, 95th percentile in the last 5 years. So again, another one of those extreme indicators that we expect. Okay, we know we've kind of hit the bottom here. We expect, just like in June, where we had this drop right there that got us down to the 200-day moving, right about actually to these levels on an absolute basis. Even if we were well above the 200, we are below the 200 now, but you can kind of see how we're bottoming out here potentially at the same level that we did there in June. So, you know, there's this, you know, thought that we'll probably get some kind of move now again, like we had back in this time frame, where we had a really big jump. Over 80% of the S&P was above the 200-day moving average, and then we dropped down to 40% during that time in June. And again, probably something similar we would expect it to happen here this go around as well. All right, if we take a look at the sector performance, let's take a look at how that's been going here this week. Remember, on a broader asset basis, it's been the large cap tech names that have really been outperforming here this week. Well, you can see here, aside from a brief stint of utilities and real estate doing well yesterday, at the end of the day yesterday, technology and discretionary are the biggest winners. Communication services lagging behind the broader market. Real estate still kind of hanging in there. But our recent winners, industrials, energy, financials, materials, all lagging behind. So again, it kind of shows that their recent strength that they've had over the past few months. So, again, going back to especially the October, but if you go to, I believe it was the 25th, it was the 25th there of September, they've been the biggest winners. Energy, financials, industrials, materials, communication services, one of them. They've been the biggest winners here, and now they're starting to lag as these other industries start to take hold. And your safe haven areas, which have been lagging behind so much, they're going to have an opportunity. They're going to have relative value compared to some of these really overbought sectors. Here's what the 12 grid looks like for these. If I were to go to the sector 12 grid here, you can see the cyclical areas here still well above their moving averages with strong intermediate lines up above 90. Some of these others not so much, right? Utilities and real estate have dark pink shading, and utilities has a red line. Healthcare is the first one. They go light pink. Still has a green line, but it's light pink. And you see some of these others that are in the 80s that are falling, that are closer to moving averages. They've pulled back here. So we'll see if they end up having some kind of a light pink shading and potentially into the dark pink realm. Like I said, we're utilities all the way down below the 10th percentile. All right, so for our trade idea of the day, I wanted to take a look at AbbVie. If you look at AbbVie here, you can see it's had a pretty decent little pullback itself before getting this piercing line pattern with today's bounce up to the upside. A nice, good bullish candlestick pattern there, gapping down and then closing well in the upper half of the large bearish candle that we just barely had. We never did get light pink shading or yellow lines. We didn't get that bullish of a pattern there from that perspective, but our short-term sentiment's rolling up. The intermediate posture is still strongly bullish, still above its market sentiment pretty easily. You look at its long-term chart here. Obviously a little bit of a transition candle there, but we are still above the 50-day moving average and the 200-day moving average. You look at the 3 green arrow chart. We did pull down to the 30. Here we do have 2 red arrows. The histogram is starting to roll up there. This is what it looks like here. Histogram rolling up, which means we're just slowing down. There gives this gap here between these 2 lines. We are back above the 17-day moving average after having closed below it yesterday. You look at its other indicators, the RSI bouncing, almost back up above 60. The CCI getting back up above negative 100, so not really spending a lot of time down there. The DMI also shows the pullback that we've had, but the positive index is not breaking below 20. The negative index is actually pulling back down below 20. So while the directional move seems to be ending, it appears that this pullback, this short-term exhale, is probably also ending too. And you can also see from a Bollinger Band perspective where we pulled down to, back down into this volume node area that we're at here after breaking below it a little bit, getting down to the July highs. Well, we came down to the July highs and we bounced off of that. And back after a brief stint below in the lower half of the Bollinger Bandwidth, we're right back up above it. So a little, good exhale chart, a good exhale charts on the AbbVie, and it looks like, but there's opportunity for this to bounce back up. Not too gung-ho about a directional move, so that sets us up for a selling a 100, buying a 97.5 bull put spread. This is what it looks like here. So you get, about a 30% return on risk with the credit that you're getting in between there. And then now, as long as it stays above 100, you're fine. We're at 104.64. This is what it looks like on the intraday chart. V. So we'd have to break below today's low and nullify this kind of move higher up above the 4-week point of control to say, okay, we're going to break, through this volume area below 100 and beyond. That's what it would take for us to get out of this trade, with hopefully at most $300 out of the 1,000 that or 950 that I'm position sizing around. All right, that wraps it up for me here today. You've heard from me. Now I want to hear from you. Use that link to go to our Market Outlook forums. You can open up any new thread there with any questions or comments you have about today's video. Comment on other people's threads, and let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon, as well as on like today's Market Outlook posts on Twitter and Facebook, and comment on our video. Again, have a great rest of your Wednesday night, everybody, and we'll see you all next time.